Welcome back, folks. In this video, you will learn a model that is based on three simple ICT concepts. Each of these concepts covers a very specific part of your trading career that will help you get your profitability and reach your maximum potential being a trader. We will go from your daily base to your trade setup and then entry model. Literally, this is going to be all you ever need to be a profitable ICT trader. So let's start and jump right into it. For the sake of name, I called it P2F ICT Combo. You can call it whatever you want. Doesn't matter much. My intention behind this video is to give you something very particular and special so that you can become profitable in your trading career. If you are not a gambler, there are three requirements to make profit in any market. These three requirements are daily base or market direction, trading strategy or model, and very specific entry pattern. In this video, I'll give you all of these things using three ICT concepts alongside liquidity as our target. These three ICT concepts are ICT P03 AMD Pattern, ICT 2022 model, and at last, ICT breaker block or fair value gap entry. The three concepts to be used. As I said, using only three concepts alongside liquidity as our target, we'll assemble a model that is very precise and work every single day. Once again, these three concepts are ICT P03 AMD pattern. We're gonna use it for our daily base or market direction, in which we're gonna look at the higher time frame formation and do the research on our manipulation phase on lower time frame. Then we have ICT 2022 model, and then we have ICT fair value gap entry pattern. I'll briefly explain each of these in the next slides with a couple of examples. Then we'll jump straight into the model and see how can we use it. Our very first step is for daily base, which is AMD P03 pattern. AMD P03 pattern are the market patterns built in algorithm to deliver the price action in three key stages. These actually break down the range of candle in few parts, describing the market anatomy. AMD stands for accumulation, manipulation, and distribution. Accumulation refers to consolidation, which is before the formation of new candle, and here smart money accumulates the order and we trap the retail traders and false idea of support and resistance. Then we have manipulation phase, which is after the accumulation and opening of new candle. This is actually expansion in opposite direction to create the wick of new formed candle, and this is retail trap for the breakout traders and support and resistance traders. Then we have distribution phase. This is the actual market direction expansion toward withdrawal liquidity, in which we find the opportunities to ride. Accumulation is a common consolidation phase before candle formation and after candle formation. Bullish manipulation refers to bearish higher time frame candle formation, and bearish manipulation refers to bullish higher time frame candle formation. This statement is the key to finding the daily base. ICT P03 breaks down the range of candle with respect to opening price and expansion after it. We buy below the opening price and sell above the opening price. Now, the statement right here, which says bullish manipulation refers to bearish formation and bearish manipulation refers to bullish formation, this is the key to your daily base and market direction. And this here, buy below the opening price and sell above the opening price, is the key to your execution. If you look at the depictions here, you can see this is our higher time frame formation right here, and this is our lower time frame structure. You can see after the accumulation right here, we do the bearish manipulation, and a bearish manipulation refers to bullish formation on our higher time frame. We buy below the opening price or near the opening price and sell above the opening price. If we are bullish, we're gonna look for this formation on our lower time frame with bearish manipulation. If we are bearish, we need a bullish manipulation just like this and then drop down, and we will sell near the opening price, near the sell zone toward our drawn liquidity. If you look at the example in form of candles, this is Euro USD by the way, you can see after this accumulation, a small accumulation, after the opening price, we do the bullish manipulation, which is too aggressive, and it hits a higher time frame breaker block right here. Then it rejects, comes back into the range, and create this fair value gap. Now, after this rejection, we know that price has done accumulation and a bullish manipulation. After this bullish manipulation, we know for sure that market is going to go bearish. Why? Because bullish manipulation refers to bearish higher time frame candle formation, and bearish manipulation refers to bullish higher time frame candle formation. Now, where do we execute our trade? We sell above the opening price and buy below the opening price. You see here, price gives us nice opportunity inside this fair value gap. We sell and then buy below the opening price near the closing price. Our next step is model, which is ICT 2022 model. This model is based on liquidity sweep, market structure, and fair value gaps aligned with our higher time frame bias and order flow. Finding correct drawn liquidity aligned with higher time frame PO3 AMD pattern is crucial in order to enter profitable trades using this model. And higher time frame key level that supports our idea of being short or long can increase the probability of profit by 30% or more. We basically look for this model formation after the price runs through the clean liquidity levels and then proceed to our entry patterns. At last, this model can be simplified in 3 steps. Our very first step is to determine our drawn liquidity. Here we look for the clean levels like relative equal highs or relative equal lows. This drawn liquidity has to be aligned with our PO3 and AMD pattern, which is our previous step. Just like if we are looking at bullish manipulation above the market price, we need a bearish drawn liquidity. And if we are looking at bearish manipulation, we need a bullish drawn liquidity. Then we look for the market structure in second step. Here we look for the stop rates and market structure shift. After the market structure shift, we look for the fair value gap entry, which is our next step, and the retracement. Keeping an eye on higher time frames while using this model can really unlock a lot of opportunities for you. Now, if you look at the depictions here, you can see after taking the buy side liquidity right here, as I said, we look for this model after the buy side or sell side liquidity has been taken, and we align with our PO3 AMD pattern. This is accumulation, and then we have bullish manipulation right here, and then we drop down, break the structure, doing short-term stop rate right here, and then we retrace, and price gives us entry going toward our drawn liquidity. Now this thing here is aligned with our higher time frame PO3 AMD pattern, and we are also taking buy side liquidity going toward our drawn liquidity, which is sell side. If you look at the example in the form of candles, this is our opening price right here. We go below it, creating a relative equal highs and liquidity right here. After price goes in the London kill zone, it does this aggressive bullish manipulation right here. And we know that bullish manipulation refers to bearish formation of higher time frame daily candle. And this is 15-minute chart. So after the stop rate, we want to see a break of structure, which is right here. You can see price broke through it aggressively, creating this fair value gap right here above these equal highs. We have taken buy side liquidity. We are going towards sell side liquidity. We come back to the price right here inside this fair value gap above the opening price, and we go toward our drawn liquidity aggressively. Our next concept to be used is fair value gap entry. First of all, let me define what is a fair value gap. A fair value gap is a gap in delivery of price algorithm due to inefficiency of either buy side or sell side. It offers us fair prices to either buy or sell a certain asset with respect to time, hence we call it fair value gap. This 3-candle formation at a key level after the stop rate can act as an entry trigger when the price reverses back to it. We intend to enter 2 strong levels of fair value gap, which are the starting of fair value gap and 50% of it, which is consequent enhancement. Remember, a fair value gap formation is only significant if it's at a key level inside a kill zone, or it has taken a lot of buy side or sell side liquidity above or below an old low or high. The presence of other PTOs around fair value gap like breakers or block increases the probability of trade being a success. If you are familiar with these concepts, you can align the fair value gap with these breaker and order blocks and use them as an entry confluence as well. A fair value gap can be reused as an inversion fair value gap once the price disrespects it. And now if you look at the depiction right here, our very first requirement for the fair value gap that will act as our entry pattern is that we must do a short-term stop trade, which took some buy-sell liquidity in case of bearish fair value gap and sell-side liquidity in case of bullish fair value gap. Here, this is the example for bearish fair value gap to go short. We have some higher time frame key level above the price as stop rate, and then we react aggressively, breaking a low. After breaking this low, we look for the fair value gap within this leg, and once we find it, when price comes back into it, retracing up, we execute toward our drawn liquidity if we are bearish, being short, and we can reverse it for the bullish market. For the sake of example in form of candles, you can see we have this buy-side liquidity right here and the sell-side liquidity, these relative equal lows and this low. We are going higher, taking this buy-side liquidity right here, and then we react aggressively, break a low right here. This is market structure shift. This fair value gap is where we execute our trade from these candles. Now, why is this fair value gap an entry model? Because we have taken the buy-side liquidity, we have clear sell-side liquidity as target, and price is respecting this level with this breaker block and fair value gap. We can execute from these levels toward our drawn liquidity using this fair value gap entry. Now, this can be a lower time frame formation. On higher time frame, it would be different. So try to remember what we have learned back in these slides. Now let's look at the examples of all these three concepts working together. Our very first example is of Euro USD. This is daily chart. I actually call these moves inside my free Telegram. We are going from ERL to IRL, buy side liquidity to sell side liquidity. We are targeting the lows, so we will look into this candle right here and look for the opportunities on 15-minute chart and see what is going on. We are on our 15-minute chart. This is Euro USD 15-minute chart. 2nd October 2024. You can see accumulation right here, a bullish manipulation, and then distribution. This aligns with our ICT PO3 AMD pattern being bearish. We have this accumulation and then a bullish manipulation aggressively taking a high right here and these relative equal highs. After this, price breaks down and do the distribution, giving us opportunity above the opening price. Now this qualifies our very first step of ICT PO3 AMD pattern. And we have also a drawn liquidity as sell side target, which also aligns with this AMD PO3 pattern. Our very first step is clear. On to our next step, which was stop trade and market structure shift with drawn liquidity. You can see we have this stop trade, a market structure shift toward our drawn liquidity. For the sake of entry, we need a fair value gap inside a kill zone, and price should respect it. And we execute our trade above the opening price to sell and below the opening price to buy. You can see price offers us entry above the opening price, respecting the AMD PO3 pattern. We have already done a market structure shift. We are targeting the sell stops. So we can execute from any of these candles toward the sell side liquidity. This concludes our first example, in which our very first step was to look for the alignment of AMD pattern, and we already have a bullish manipulation, then bearish distribution. Our second step was market structure shift, stop trade, and fair value gap. Our third step was selling above the opening price inside a fair value gap. Once fair value gap is qualified to be an entry pattern inside kill zone. On to our next example. This is USD JPY daily chart. You can see after these sell side liquidities has been taken, we are going bullish toward buy side liquidity, and now we are looking at this part right here, these three candle formations after this fair value gap. We will go on lower time frame and look for opportunities. This is USD JPY 30-minute chart, 8 October 2024. After price hit the C of daily fair value gap we saw in previous slide, you can see price did this market structure shift right here, and we qualified to be bullish with this accumulation and bearish manipulation right here. You see how aggressive this bearish manipulation is. After this bearish manipulation, we look for bullish opportunities with each bearish candle. We have already taken sell side liquidity and we have clear buy side target on higher time frame and on our lower time frame aligned with PO3 pattern. This is 15-minute chart. After price respect these fair value gaps, just like this one and this one and these ones, we can execute our trade to add our drawn liquidity and close it right here. This concludes this example, and these should be our executions. I actually executed this trade and also sent the analysis inside my free Telegram. So that's how we use this model using 3 concepts. Our very first step, I'll quickly repeat everything I told you. Our very first step is to see alignment of ICT PO3 AMD pattern. Our second step is to apply ICT 2022 model, which covers the structure, liquidity, and some stop hunts. After that, our third step is to look for entry pattern using fair value gaps. This entry pattern should respect the ICT PO3. We buy below the opening price and sell above the opening price. That's it for this video. I want you to backtest it and practice it a lot. Subscribe for more content. Stay sharp, stay safe.